Hi everyone, welcome back to my commerce class. Today we are going to learn the new concept royalty called royalty accounts. Okay, so this is the royalty accounts. So let us know the meaning of royalty. So royalty is an amount payable for utilizing the benefits of certain property or the right of some other person. So that means it is an agreement between the two parties called the lessee and the leaser. That means the owner and the user. It's an agreement between the owner and the user of the property, wherein the user, the lessee, is going to make a periodical payment, that's the royalty, to the leaser for utilizing the property. Okay, so it's an amount paid for utilizing a particular property. Okay, so the owner is not going to use the property but is going to lease that property someone, and for that purpose the person who uses the property for any economic activity, whatever that he earns, out of that some money will be paid, and that money is called royalty. Okay, for example, you take an example of mining of a land. So that means that the mining land that will be leased, the owner is going to have a lease with someone who is going to extract minerals from the mining land, and the person who is utilizing the land, mining land, he is going to give the royalty to the owner for utilizing that mining land. Okay. Likewise, the author is going to write the book. That patent will be taken by the publications. So these publications, they are going to give the royalty to the author. Okay. So they have taken the patent, the copyright over the book, and they are going to publish and they'll market it. Whatever the money earns out of that, some money will be paid to the author as per the agreement, and that money what they are going to pay periodically is called royalty. Okay, I think you're clear about it. In that royalty accounts, for accounting process, we need to learn some important terms. The one is minimum rent, another one is short workings. Okay, now let us know the meaning of minimum rent. So it is an amount which is payable to the owner irrespective of the production. That means sometimes your production may be less. Usually the beginning period of the business, the production may be less and your profit or your turnover may be less, but still you have to pay minimum amount. We call it as a fixed amount also. So that fixed amount to be paid. Okay, so the fixed amount what you are going to pay, that is also called dead rent. Okay, and that is the money which is to be paid usually when your royalty is less than the minimum rent, you are going to pay amount equal to minimum rent. That means whenever the royalty is less than the minimum rent, the money payable in terms of royalty will be equal to the minimum rent, which is fixed, which is decided at the time of royalty agreement. Okay, and that minimum rent whenever you have, that means the money what you are going to pay equal to the minimum rent means the shortage of money what you have paid, that will be called as short workings. That's why it's defined as the excess of minimum rent over actual royalty. Excess of minimum rent over actual royalty, the difference what you are paying to meet your minimum rent, that is called short workings. Okay, and such short workings can be recouped, okay, can be recovered out of surplus of the royalty in a coming years. That means in subsequent years, that may be for a particular period of time, or maybe first 3 years, first 4 years, like this. There will be an agreement. So as per the terms and conditions of the royalty agreement, the short workings can be recovered by the lessee. Okay, that's the important terms, minimum rent and short workings, that you have to know, and how the short workings can be recovered, that you should know. Based on that, you are going to prepare royalty analytical table. Okay, so this royalty analytical table gives the details of what is the output you have done, what is the royalty amount, that means per ton or per piece of sales, like that royalty is fixed, and what will be your short workings, how you are going to recoup your short workings, and what is the actual amount of royalty payable. So all these things to be clearly defined by using this table. It's a royalty analytical table. I'll take an example to understand this royalty analytical table. Okay, so look at here, there is an example that I have taken to understand the royalty analytical table. Okay, this is a problem. From the given information, prepare royalty analysis table. So royalty payable is rupee 1 per ton of output. Okay, and minimum rent is fixed at rupees 15,000, and the right to recover the short workings is given up to 4 years, and output for the first 4 years is given 10,000, 14,000, 18,000 and 23,000. So let us work out this problem. Okay, so this is a simple problem where the minimum information is given. Based on that, we have to prepare the royalty analytical table. Look at this table. Okay, so this table contains these many columns: year, output, royalty, minimum rent, short workings, surplus, recovery of short workings, and the actual royalty payable to the owner of the property, the leaser. Okay, so here we got the 4 years information. So 1, 2, 3, 4 year. Depending on the information available, we have to create the number of years. Okay, and output is given 10,000, 14, 18 and 23. That's what we have written here. Okay, that's what we have written. And royalty is to be multiplied with the amount of royalty per unit or per ton payable. That's given in the problem. Here it is rupee 1. Okay, so rupee 1 it's written here. According to that, output multiplied by the royalty amount 1 rupee. So 10,000 into 1, 10,000. 14,000 into 1, 14,000. 18,000 into 1, 18,000. 23,000 into 1, 23,000. So if it is 2, it becomes 20,000, 28,000 like this. So now it is 1, so we are getting the same amount. Okay, and minimum rent, it is as per the agreement given 15,000. So sometimes this minimum rent varies from year to year also, but in this problem it is 15,000 for all the years, so we have written 15,000. Okay, and now let's calculate all these remaining columns: short working, surplus, recovery and all. We have to do it. Okay, how we are going to get the short workings? It is defined excess of minimum rent over royalty. Short workings is excess of minimum rent over royalty. So in the beginning period, you have to meet the minimum rent. So when the royalty or when the production is less, you are paying minimum rent. So that means there will be shortage of fund which is not royalty is not equal to minimum rent. Then you are going to make payment. Whatever the payment you are going to do, that becomes the short workings. Okay, look into this royalty column. Here we have 10,000, whereas in minimum rent it is 15,000. The difference is 5,000. Okay, and that difference is called short workings. We are getting minus value. Whenever royalty is less than minimum rent, we call it as short workings. Here also it is 14,000, whereas minimum rent is 15,000. Minus, you are getting the minus value becomes the short workings. Look at here, in the third year, royalty is 18,000, minimum rent is 15,000. So there is a surplus. Royalty, you are getting more than the minimum rent. So you are going to write it in the surplus column, 3,000. Okay, and even in the fourth year also, your royalty is more than the minimum rent. The surplus amount is written in the surplus column. Okay, and as per the agreement, right to recover the short working is given up to 4 years. Okay, that may be first 3 years, first 4 years, first 5 years. Likewise, they'll mention the number of years by which this short working can be recovered, can be adjusted out of the surplus to minimize the loss. Okay, the lease is going to do it as per the agreement. Okay, and according to that, first 4 years means 1, 2, 3, 4. This 4 year surplus, whatever that is there, that means you got surplus in third year and fourth year. This surplus can be utilized to adjust this short workings, to recover this short workings. So what is the total amount of short workings? 5,000 plus 1,000. Total you have 6,000. Okay. So out of that 6,000, in the first year you have recovered 3,000. 3,000. So in the third year it is recovered 3,000. And remaining 3,000 will be recovered in the fourth year. Okay, so even though surplus is 8,000, you are recovering only 3,000 because that is the money, the balance what you have in the short workings. Surplus 8,000 cannot be recovered. Okay, only the amount what is required to recover the short working, only that much to be written in the recovery column. Okay, now the last column is royalty payable, the money that is to be paid to the owner of the land or the landlord, the leaser. Okay, and whenever there is a short workings, you are paying equal to your minimum rent, 15,000. Whenever royalty is less than the minimum rent to be paid. Whenever the royalty is less than the minimum rent, you are going to pay equal to minimum rent. Okay, and in the third year there is a surplus. What you have to do? 18,000 amount is the royalty, and the recovery what you have done is 3,000. So you have to pay 15,000. And in the third year, the royalty amount is 23,000, but recovery is only 3,000. So you have to pay the royalty of 20,000. You have to pay the royalty of 20,000. Okay, this is how you are going to make the payment. Here it is 20,000. Okay, so that means you are going to adjust only the amount what is recovered, 20,000. So first year it is equal to minimum rent. Second year also equal to minimum rent because there is a short workings. Third year there is a surplus. Whatever the surplus adjusted to royalty to be considered, 18,000 minus 3,000, 15,000, 23,000 minus 3,000, 20,000 you are paying. In the last year you are paying 20,000. Okay, so likewise you have to prepare the royalty analytical table. I hope that you are clear about the information. In the coming videos, I am going to take the problem related to journal entries as well as ledger accounts. Okay, so like, share and subscribe. See you in the next video.